Most people lose money in crypto not because they picked the wrong coins, but because they tried to be clever about when to buy them. Think about that for a second. The average retail trader spends more energy trying to time the perfect entry than they spend on anything else. They watch charts at 2 a.m. They wait for the dip. They hesitate when the dip finally comes because now they're scared it'll dip further. And while they're sitting on the sidelines doing all that mental gymnastics, the market quietly moves on without them. There's a study that looked at investor returns in one of the best-performing mutual funds over a 20-year period. The fund itself returned around 29% annually. The average investor in that fund lost money. Same fund, opposite result. How? They kept jumping in and out trying to time things, buying high out of excitement, selling low out of fear, over and over. This is why dollar-cost averaging exists. And before you tune out because it sounds boring, hear me out, because boring strategies are the ones that actually compound. The concept is brutally simple. You pick an asset. You invest a fixed amount at fixed intervals regardless of price. $100 every week, $500 every month. Whatever the number is, it doesn't change based on how you feel or what Twitter is saying. When the price is high, your fixed amount buys fewer units. When the price is low, it buys more. Over time, your average cost per unit smooths out. You stop gambling on a single moment and start building a position across hundreds of them. Here's what nobody tells you about this, though. The real power isn't the math, it's the psychology. When you remove the decision of when to buy, you remove the two biggest destroyers of returns: greed and panic. You can't FOMO into a top if you're already buying on a schedule. You can't panic sell the bottom if your system doesn't ask for your permission. Bitcoin went from around $69,000 in November 2021 down to under $16,000 by November 2022. That's a 77% drawdown. Someone who timed that peak and held lost most of their money on paper. Someone who decoded through the entire crash accumulated more Bitcoin at lower prices and came out positioned for the recovery that followed. Same asset. Completely different outcomes based on behavior, not brilliance. Consistency isn't exciting. It doesn't make for great screenshots, but it is the single most repeatable edge available to anyone who isn't a professional market maker with a Bloomberg terminal and a risk desk behind them. The disciplined traders aren't the ones glued to charts. They're the ones who built a system and let it run. Vishmaster automates exactly this at vishmaster.live.